This LOS is calculate and interpret major return measures and describe their appropriate uses. Return. Financial assets normally generate two types of return for investors. First, they may provide periodic income through cash dividends or interest payments. Second, the price of a financial asset can increase or decrease, leading to a capital gain or loss. You should be aware that returns for reported stock indices are sometimes misleading because most index levels only capture price appreciation and do not adjust for cash dividends unless the stock index is labeled as total return or net dividends reinvested. Cash dividends are an important part of total return. It is important to recognize and account for income from investments. Holding period return. A holding period return is the return earned from holding an asset for a single specified period of time. The period may be 1 day, 1 week, 1 month, 5 years, or any specified period. So here we have the calculation. The return is the ending price minus the beginning price plus the dividend, but note that's at the same time, time t, which is the same time as the ending price, divided by price at t minus 1, which is just the beginning price. So again, we've seen this before in previous LOS, a holding period return, ending price minus beginning price plus dividends divided by the beginning price. Now to compute a 3-year holding period return from 3 annual returns, in that case what we want to do, the holding period return is computed by compounding the 3 annual returns. So the 3-year holding period return would be 1 plus return 1 times 1 plus return 2 times 1 plus return 3 minus 1, where return 1, 2, and 3 are the 3 annual returns. Most holding period returns are reported as daily, monthly, or annual returns. So we'll just work through an example. What is the 3-year holding period return if the annual returns are 7%, 9%, and negative 5%? So again, we said to calculate the holding period return from 3 annual returns, we would do it by compounding. 1 plus return 1 times 1 plus return 2 times 1 plus return 3 minus 1. So I just have the calculator up here. We can do that 1.07 times 1.09 times 0.95 equals minus 1. And we've got 10.7985. So that would be closest to 10.8% approximately. Arithmetic or mean return. We can calculate the arithmetic return and its standard deviation to determine how dispersed the observations are around the mean. So the arithmetic mean is simply the sum of the numbers divided by the count of the numbers. The geometric mean return. Because of the effect of compounding, the geometric mean return is always less than or equal to the arithmetic mean return unless there is no variation in returns, in which case they are equal. So the geometric return is the n square root of 1 plus return 1 times 1 plus return 2, etc. So we're just going to work through a little example here to see why when we're dealing with investment returns, we should always use the geometric mean return. So here we have an example where we have 3 returns for 3 different periods. Return 1 is negative 50%, return 2 is plus 35%, and return 3 is plus 27%. So to calculate the arithmetic mean return is very easy. It's the sum of the numbers divided by the count of the numbers. Negative 50% plus 35% plus 27% divided by 3, and we get an arithmetic mean return of 4%. If we calculate the geometric mean return, though, it's 1 minus 0.5 times 1 plus 0.35 times 1 plus 0.27 to the, sometimes we can write that to the power of 1/3, or the third square root, and we get actually a geometric mean return of negative 5%. So if we just work through this example, we put return 1, return 2, and return 3 here, that if we started with $100 and you had a negative return of 50%, you'd have $50. And then in the second period, if you had a 35% return, you'd have $67.50. And at the end of the third period with a 27% return, you'd have 85.73. So that's why I said if we're looking at investment returns, that's the correct balance. And if you use the geometric return of negative 5%, 100 times negative 5%, 95. 95 times negative 5%, 90.25. 90.25 times negative 5%, 85.73. We've got the matching correct balance. However, if you use that arithmetic average return of 4%, 100 times 4%, 104, times 4%, 108.16, times 4%, 112.49, that doesn't match the correct balance. So it's important not to use arithmetic averages when looking at average annual investment rates of return. So we'll just look at another quick example with regards to the geometric mean return. When looking at historical returns on investments, we want to use geometric averages. This quick example will show why. This example will be familiar to you because we use the same one when we cover this in the quants, and that's why there's overlap between some of the quants in CFA Level 1 and also in portfolio management. So in this example, we start with US dollars 10,000, and we had the following returns for 4 years: plus 10%, minus 25%, plus 21%, plus 6%. So to do the arithmetic average, it's 3% return, the sum of the numbers divided by the count. If we use that and calculate it as 10,000 times 1.03 times 1.03 times 1.03 times 1.03 for the 4 years, we get a total of 11,255. But that's not what the balance would be in our account if based on those returns. So let's do it. Let's do the math again. 10,000 times a 10% return in year 1, you'd have 11,000 at the end of year 1. 11,000 times a negative 25% return, you'd have 82.50 at the end of year 2. 21% return in year 3, you'd have 9,982 and 50 cents at the end of year 3. And then finally, with a 6% return in year 4, you'd have 10,581.45, which is quite different from the 11,255.08 if we used a 3% average return. So on this slide, if we calculate the geometric average, I won't go through all the math because that's a review from the quants, but you'll see that we'll calculate 1.42296%. So now if we use the geometric average and just do that simple exercise of 10,000 times 1.0142296 4 times, you'd get 10,581.45. And that is the correct balance in the account after 4 years. Using the geometric average adjusts for the fact that after a negative year, there's less balance in the account on which to apply the following year's return. So it's important not to use arithmetic averages when looking at average annual investment rates of return. I think we've shown you 2 nice examples that consolidates that fact. Money-weighted return or internal rate of return. The money-weighted return accounts for the money invested and provides the investor with information on the return she earns on her actual investment. The money-weighted return and its calculations are similar to the internal rate of return and the yield to maturity. Just like the internal rate of return, amounts invested are cash outflows from the investor's perspective, and amounts returned or withdrawn by the investor, or the money that remains at the end of the investment cycle, which is a key point, is a cash inflow for the investor. Okay, now we're going to walk through 2 examples that shows the money-weighted return or internal rated return. So here's example number 1, and then we've got another example down here. So just to go through it twice, okay? So in this example, you're going to start with 0 balance, and you're going to do a new investment at the beginning of the year of 100 euros. So that's your balance at the beginning of the year, 100 euros. In year 1, there's a negative return of 50%. So your gain or loss, it's a loss in this case of 50 euros. And the balance at the no withdrawals at the end of the year. So then, of course, started with 100 euros, you lost 50 euros. You have a balance at the end of the year, which is 50 euros, and that becomes obviously your balance at the beginning of the next year. So at the beginning of the next year, there's another investment by the investor, 950. So as we said, these new investments by the investor, that's cash out. So when we use the financial calculator, we're going to use the negative sign. And cash back into you, withdrawal by the investor, even though it shows as a negative here, is a positive. It's back to you. We use the positive sign. And similarly, the balance at the end of the year, we're also going to use as a positive cash flow. You can see down here that's a CF3, but we'll get to that in a minute. So we go through this table again. That's year 2, 950 put in. So you've got €1,000, 35% return, which is 350. Took out 350, so you had 1,000 at the end of the year. So you got 1,000 at the beginning of the next year. No new investment. 27% return, so that's 270. So at the end, you've got the 1270. So how do you calculate the money weighted return? We're just going to look at the cash flows. So as the slide said, money out of your pocket, investments is a negative, withdrawals, and the balance at the end of the time that you're looking at is a positive. So if I just bring up the financial calculator here, then we can do the cash flow. I'll go to my cash flow and I'll just clear the work. So it's second, clear all my work. So the first one here, I've shown you the cash flows here. CF0, that's the 100. That's the first investment by the investor. So that's 100. Negative, we're going to enter that. Arrow down. Cash flow 1 is the 950 that the investor puts in. So 950, negative sign. We're going to hit enter. Frequency on that of 1. Arrow through. Cash flow 2, that's the 350 withdrawn by the investor at the end of the year. So that's a positive 350. We're going to hit enter. Frequency 1, arrow down on that. Finally, there was no new cash investment, but we have to use the balance in remaining as a positive. So that's a 1270 positive for cash flow 3. We're going to hit enter. Then we'll go to the IRR button. We'll hit compute. And we've got an internal rate of return 26.10. Okay, so you can see here they have a cash flow. They're taking withdrawals at the end of the year, and here there was no new investment at the beginning. If that was the case, we would net them off for the cash flow. We're going to see a practice problem with that later. Because that's the reason why I wanted to show 2 examples is because on this one, the second one, they're starting with 0. They're doing a new investment, so I've circled in green the new investments always because those are definitely cash flows. But then they have a withdrawal by the investor. This is also at the beginning of the year. This is not at the end of the year, okay? So we need to be careful with that because we can see here it says new balance at the beginning of the year. So here they made an investment of 30, so that's our first cash flow, okay? And there's no withdrawal. 30, 15% return. I won't go through this whole table, in the interest of time, but I just wanted to show you. So we go through the cash flows. There was a withdrawal at the beginning of the year, so that is a positive 2275, and at the next year there is a new investment of 3. Now, as I said, if that was at the end of year 3 and the beginning of year 4, you would net those off, but that's not the case. You have to read it very carefully because this is the beginning of the year. New investments are made at the beginning of the year and withdrawals are made at the beginning of the year. So on the second one again, so you have to identify the cash flows, and this is the skill sometimes in the CFA. They give you a lot of information, especially as you head into level 2 and level 3. A lot more data is thrown out to you, and you have to filter through and use the numbers that you need. And that's why I'm using these 2 examples to show you that if they give you a table like this, fair game, there's a lot that you have to sift through to say, well, I need the 30, I need the 1050, I need the 2275, I need the 3, I need the 625, and then down here I need the 36 because that's the balance at the end, which is a positive cash flow. So I won't bring up the calculator again. You can practice that on your own. But the IRR or the the money weighted rate of return on that is going to be 5.85%. And I just made a note here. Look, the withdrawals at the beginning of the year. If it's at the end of the year, you're going to net the 2. You're going to see a little question with that next couple slides. So the next few slides, I'm going to go through 2 different practice questions. In the first one, you have to do a lot of subcalculations in order to get the correct answer. In the second one, it's relatively quick. And that's the whole thing with the different types of questions on the exam. Sometimes they're easier and sometimes they're harder, and they're regarding the same LOS, in this case, the money weighted rate of return. So let's look at this first one where you have to do a lot of calculations. That's why this says practice question part 1 of 3. There's actually 3 slides to it. So an investor's transactions in a mutual fund and the fund's returns over 4-year period are provided in the table below. So that's a lot like we saw in the previous slide, the data that's given to us. The new investment at the beginning of the year, the investment return for the year, the withdrawal at the end of the year, okay? So you've got year 1, year 2, year 3, and year 4. And based on these data, the money-weighted rate of return or internal rate of return for the investor is closest to A, 2.15%, B, 3.96%, or C, 7.5%. So you can see the challenge with this one. The math is not difficult, but there's just a lot that you need to do in 90 seconds. So definitely some questions take longer than 90 seconds, and some questions are easier. And if you want to get full marks, you're just going to have to crank your way through it. So the table becomes a lot like we saw 2 slides ago. You have a starting balance of 0, made a new investment of $2,500. So that was the balance at the beginning of the year. Negative 20% return, which is $500. So you would have $2,000 at the end of the balance at the end. So definitely our cash flow is that new investment. That's going to be CF0, the negative 2,500. Okay. Then we're going to have starting balance $2,000. Oh, another new investment. So that's another cash flow, $1,500. So the balance in the account is $3,500. That's what we're going to apply the 65% return to, which is $2,275. But there's a $500 withdrawal by the investor, so we know that's a relevant cash flow. And so we're going to have the balance $5,275 at the end of the year, which becomes your beginning year cash flow. Another new investment of $1,000, we're going to need that. So we have the balance $6,275 minus 25% return, which is negative $1,568.75, and another $500 withdrawal by the investor. And so we have a balance 4206.25, no new investment here, okay? So as I said, the thing that we had to look out for is that this withdrawal at the end of the year and then a new investment at the beginning of the year, well, that's basically at the same time. So in this case, we're going to net those out, okay? But we'll get to that in a minute. So again, we're at 4206.25 at the beginning of the 4th year, no new investment. So that's our balance at the beginning of the year. 10% return, 420.63. And the reason why we had to go through this whole table is this is the final cash flow that we need for our money weighted return is the 4626.88, which is our balance at the end of the cycle. So now on the next slide, we're going to bring up the calculator and just work through the IRR calculation on that. Okay, on this slide, I just did the table and I made it a little bit bigger and I color coded a bit just to help you with your understanding. So I color coded the cash flow. So you had your CF0 is the negative 2,500. There was no withdrawal at the end of the first year. So the next relevant cash flow was the 1,500, which is the new investment at the beginning of the year 2. But then, as I said, I put here into blue, you had a negative 500, which is a positive 500 into you. Withdrawal, it's a negative from the fund, but it's a positive to you. And then you had the 1,000 new investments. So we net those off. And then, as I said, so there's your CF2. So be careful when it says end of the year or beginning of the year, because that's going to affect how you enter the cash flows into the calculator. Okay. So then, of course, we had the positive 500, which I put in green. That's the withdrawal at the end of the year 3. And then no new investment in year 4. But you have to know the balance at the end of the 4 years. So you have your 4626.88. So if we just bring up the calculator, which will hide a bit of the table, but we see the numbers here. So I'll go to my cash flow. Second, clear the work. That was from the previous question. CF0, 2,500, make that a negative. Enter, arrow down. 1,500 was the second cash flow. That's a negative. Enter, arrow down, frequency 1 on that. C2 was the negative 500, which was the net, the end of the year and the beginning of the next year. Enter, arrow down, frequency on that is 1. And finally C3, getting which was a withdrawal from the fund, positive to me. Enter that, frequency 1. And finally our balance in the account was the 4626.88. We're going to hit enter, go to my IRR, hit compute, and it's closest to, well, it is exactly 3.96. So the correct answer is B. Often we say when in doubt, guess B, and we see with a lot of these practice questions, the correct answer is B. So not too difficult in terms of the math, but setting up the table, working through not making any silly mistakes, attention to detail, I would say that's a relatively easy question, but speed is a skill. Skill gets rewarded. You want to practice it. Now, in that previous question, if you thought that that was a lot to calculate in 90 seconds, fear not, because here's another practice question that you'll see is a lot easier, but it's still testing the same LOS, which is the money-weighted rate of return. In this one, an analyst gathers the following information about a common stock investment. There's a stock purchase of 1 share on the 15th of January 2006, 86 euros. Purchased another share a year later for 94 euros, and then sold the 2 shares at 106 per share for a total of 212 on the 15th of January 2008. The stock did not pay a dividend. The money-weighted rate of return on the investment is closest to A, 11.02%, B, 11.6%, or C, 11.89%. So the correct answer on this is B, 11.6%. You can see there's just 3 cash flows we have to enter into the calculator, no real sub-calculations at all. CF0 is the $86 out of our pocket, so we make it a negative. CF1 purchased a stock again, it's money out of our pocket, so it's a negative. And then finally we sold the 2 shares for 212, which is a positive, CF2, and we compute the IRR. So if I bring up the calculator very quickly, just going to hit clear. Cash flow, second, I'm going to clear my work. So it's 86 negative, enter for our CF0, arrow down. 94 negative for C1, enter, arrow down, frequency 1, and our final cash flow, just the 212, which is positive. Enter that, hit IRR, hit compute, 11.5953. That is definitely closest to B, 11.6. You can see that is not a 90-second question. Very easy peasy. So you'd be happy with that one. Now we're going to look at annualized returns. A monthly return is compounded 12 times, a weekly return is compounded 52 times, and a quarterly return is compounded 4 times. Daily returns are normally compounded 365 times. For an uncommon number of days, we compound by the ratio of 365 to the number of days. So here we'll just go through a couple of examples. Here's a 4-week return. So that's 1 plus the return for the 4 weeks. If we want to annualize it, we're going to put it to the power of 52 divided by 4 minus 1. Okay? For annual return, if we had a return for 20 days, 1 plus the return to 365 over 20. I think you see where this is headed. If we have a return for 3 quarters, it's 1 plus the return for those 3 quarters to the power of 4 over 3. 4 quarters in a year, and this was a return for 3 quarters. For a 10 months return, 12 months in a year, so it's 1 plus the return for the 10 months to the power of 12 over 10. Okay? Now this is an important one which I put, it's in red, I put it in bold. If for an 18-month return, this is an interesting one. 12 months is 2/3 of 18 months. So you do 1 plus the return for 18 months, but it's to the power of 2/3, okay? Because it's for 18 months. 12 months is 2/3 of 18 months. So that's an important one. So carrying along, as we recall, the LOS that we're covering is calculate and interpret major return measures and describe their appropriate uses. So with regards to portfolio returns is just simply a weighted average. So if we look at a 2-asset portfolio, the return for the portfolio would be the weight of asset 1 times the return of asset 1 plus the weight of asset 2 times the return on asset 2. So portfolio return is easy. It's just simply a weighted average. Some other major return measures and their applications we won't cover in major detail, but just to list them. Gross and net return. We'll see that later on when we look at alternative investments and hedge funds in particular, where there's performance fees. We'll look at gross returns and we'll look at net returns after fees. Also, pre-tax and after-tax nominal returns. It's very important when we're looking at certain investments, their tax status, and looking at returns before and after tax. And finally, real returns. I put the calculation there for the real returns. 1 plus the nominal return divided by 1 plus inflation. Also, throughout the CFA curriculum, we see leveraged returns. In market organizations and structures, there's an LOS saying calculate, interpret the leverage ratio, the rate of return on a margin transaction, and the security price at which the investor would receive a margin call. So again, these are some other return calculations that you need to be familiar with. So we're just going to finish this LOS with a quick practice question. An analyst observes that the historic geometric returns are 9% for equities, 3% for treasury bills, and 2% for inflation. The real rate of return and risk premium for equities are closest to A, 5.8% and 3.7%, B, 6.9% and 3.8%, or C, 6.9% and 5.8%. So the correct answer for this one is B, and you had to remember the real rate of return calculation. So if we do the real rate of return for equities, 1.09% divided by 1.02 for the inflation, minus 1, we get our 6.9%. So we know it's either B or C. So there's another calculation there on the second row, 1.069 divided by 1.03. But listen, folks, if you calculated the 6.9% and you were correct on that, then you know 6.9% minus the T-bills, which is the 3%, you'd have 3.9%. Really, it has to be B is correct, because that's going to be the risk premium for equities, because we're going to look at the return on equities over the T-bills, okay? So you don't really need that second part of the math, but it's there as FYI. And a quick reminder there that approximately the real interest equals the nominal interest rate minus the inflation, but we like to use the formula 1 plus the real interest rate equals 1 plus the nominal divided by 1 plus the inflation. And that's the last slide for this LOS. It's been a long one. Thank you very much.